Hey everyone, this is Caleb Franzen with Cubic Analytics, and I wanted to put together this video today to basically preview the August 2022 CPI data that we're set to receive tomorrow morning at 8:30 a.m. Eastern Time. This has been arguably the most important topic of 2022 that's been impacting market dynamics across the board. So whether we're a stock-focused investor, a bond investor, a crypto investor, whatever the case is, even if we just have a well-balanced portfolio, the high inflation story plus a tightening Federal Reserve has been the predominant factor causing market pain across the board. So in this video today, I want to preview some things that I'm seeing as we get into tomorrow's inflation data, and in particular, the four main things that I've really been tracking for the past several months. So back in June, I did this tweet, but in reality, I'd actually been highlighting these four key components back in May of 2022, talking about why I didn't think inflation had peaked quite just yet. But regardless, I put together this thread here summarizing at a high level what those four main components are. But I was also talking about how in mid-June, we were really starting to see a massive decline and rollover in yields. And I know today yields are higher than where they were back in mid-June, but the thing is, the market was still giving us a fairly credible signal at the time. And so I had highlighted what those four main components were and noted that the first two seemed to be improving, which were the supply chain pressures and commodity prices. And the final two didn't seem to be improving, which were the wage price spiral and credit creation dynamics. But I did note that the dramatic decline in yields signals two things potentially. One, that inflation has peaked, or two, that economic data is contracting and weakening. I think over the course of the past, let's call it 3 months, we've seen a continuation of this data. We continue to appear as though we're trending towards a recession, and it's been clear that inflation has come down and you could possibly say moderated, though it's still far too early to tell with any concrete certainty, if you will, right? And we've seen a lot of Fed officials come out and say that, it seems as though we're moving in the right direction, but it's far too early to say that inflation has peaked and that it's rolling over. So the Fed is going to be very steadfast in their approach to combating inflation, and they're not just going to take 1 month of data, specifically looking at the decline from June to July from 9.1% to 8.5%, and declare that as a win for combating inflation. So with that being said, I want to go over some of these, some different dynamics that I'm seeing in these four markets. So first and foremost, let's go ahead and talk about supply chains and bottlenecks. What we're looking at right here is data from the New York Federal Reserve, which publishes something called the Global Supply Chain Pressures Index. And that's exactly what we're seeing right here, specifically looking at the standard deviations from the average value over time. And so what we're seeing in this data is that supply chain pressures really peaked at the end of 2021 and have come down dramatically year to date. And so we did have a little bit of a hiccup. Let me see if I could zoom in here. We did have a little bit of hiccup back here in basically, let's call it Q1 going into Q2. But what we've seen over the past several months now is a massive decline in the Global Supply Chain Pressures Index. And as of the most recent reading for August of 2022, we are let's just call it 1.5 standard deviations away from the average value. So certainly still in a, let's just call it a unique global supply chain period, but certainly trending back towards somewhat of a normal dynamic. So this is a very good sign, and again confirms some of the things that I was talking about in June, which is that supply chain pressures seem to be improving. And it was actually kind of funny when I pulled this up, I noticed this little note that the New York Federal Reserve had put in here, saying that the original August publication incorrectly stated that global supply chain pressures have eased over the past 3 months, but it's now been corrected to state that easing has been observed over the past 4 months. So that's, it's definitely a nuance. The devil is in the details, but regardless, I think the general sentiment seems to be clear, which is that supply chain pressures seem to be improving. So that's a good sign for deflation, for disinflationary market dynamics. So that's a win, basically implying that some of the August data that we could receive tomorrow, look, we had a massive decline here in the standard deviation from 1.75 to, let's call it 1.5. And so for the August data, I expect to see disinflationary or even outright deflationary dynamics caused by supply chain pressures. Next on the list was different dynamics I'm seeing in the commodity markets. And what we're looking at right here is the price of crude oil, WTI, in Cushing, Oklahoma. And the interesting thing, what I've done here is we're looking at the monthly price and specifically the average monthly price. And the thing that I like to look at right here is not only did the monthly price decline substantially from from July to August, very similar to the decline that we saw from June to July. And again, if you're a subscriber to Cubic Analytics, that was one of the main things that I was really talking about when we received the July CPI data, is saying that it seems as though all of the disinflationary dynamics that caused the decline from 9.1% to 8.5% really came from declining commodity and specifically declining energy costs and prices. And so to see another decline in the average monthly price of WTI crude fall from, let's just call it $102 to $94, that's basically an 8% decline on a month-over-month basis. So that's very good news. The thing specifically that I think, not specifically, but the thing I'd also like to highlight is that we can change this from the percent change from 1 year ago. And so what we can see when we look at this data specifically, if I could get rid of, there we go, is we had that massive spike back in April of last year, which was really just kind of caused by, I think, some of the negative futures pricing that we were seeing across the board. And it was just a very unique time in April of 2020. So I'm not surprised to see that spike there. But if we look at the 2022 dynamics, we've pretty much been in that 50 to even 75% range for months and months and months. And in June, when we basically had peak CPI inflation, the year-over-year rate of change was, let's call it 61%. Now in July, that declined to 40% year over year. So we had a massive decline from 61% to 40%. And for the month of August, we saw again a decrease in the year-over-year rate of change in WTI crude prices. Not by as significant of a degree as we saw from June to July, but still decreasing. So once again, I expect to see deflationary pressures, basically disinflation caused by energy prices for the month of August. So that's very good news for those who are calling for a peak inflation dynamic. Again, I'm still not sure exactly where things shake out. I think generally speaking, my overall estimate, particularly based on this crude oil chart right here, is that I expect to see again slight disinflationary dynamics. So perhaps we'll get right around that 8.2 to 8.4% range. I would actually be somewhat surprised if we see inflation get back over 8.5% on a year-over-year basis for the month of July, for the month of August specifically. Because remember, we had 8.5% for the month of July. But really quickly, I guess before we go all the way back to the next topic, one thing that I would like to just call out really quickly is the Goldman Sachs Commodity Index. And this is a broad-based basket of various commodities, but about 1/3 of this index is allocated to crude oil prices. And what I've added on here is the 200-day exponential moving average in teal and the 200-day simple moving average in yellow. And what we can see is that in 2021, specifically in Q4, we used this level as dynamic support and rallied substantially higher. We tried to use it as support again here in July and even again in August. And we had another substantial retest here in early September, and we're starting to regain some upside momentum. It's far too early to tell, but I've been outlining this kind of consolidation range as an important level that we should be focused on as investors. And I think one way or another, what we can see is basically for the past 6 months, 7 months even, we've just really kind of been consolidating within this range. We haven't really had any decisive market action. We did get that new year-to-date high back here in early to mid-June, but we rolled over substantially. And I think that when we think about disinflationary pressures caused by lower commodity prices, this is a very important chart to be looking at, because as this range, or as the price of this ETF kind of stagnates, if you will, it's going to decrease the year-over-year rate of change. Because if we look at 2021, we were basically rising in a straight line for the majority of the year. So as the 2022 price level stagnates here within this consolidation range, particularly around the lower bound, and as this level continues to rise, the year-over-year rate of change is going to continue to decline. So again, that should help to reduce inflationary pressures as we measure CPI on a year-over-year basis. So that particularly is what I'm going to be focused on. The thing is, if we look at the month of August, basically finishing right here around $22 a share, and if we compare that to where we finished the month of July, which was at also 22, but high 22 range, we haven't really seen too much of an improvement. Basically, the entire month of July was at this lower bound, and the entire month of August was at this lower bound. So to me, I'm expecting that the month-over-month change in commodity prices is going to be relatively flat. But if we do look at something like what people are paying at the pump, which is a massive factor for inflation dynamics, I think we've continued to see that trend lower. So that's good news. Let's get back to some of the other different data though. One of the other components that I had highlighted was loans and leases in bank credit. This is a very, very important dynamic to keep monitoring, because if we think about all the money that was printed as a result of the monetary and fiscal stimulus in 2020 and 2021, I think a lot of people have really realized that that money really tends to stay within the financial system. And the money doesn't actually become a currency or really enter the real economy until it's lent out from the financial system and into the real economy. And so monitoring something like loans and leases and bank credit is very, very important. And so if we look at the month of August, it came in at basically $11.56 trillion. And this is loans and leases for all commercial banks in the United States. This includes consumer loans, this includes mortgages, this is everything, right? But what we can see is we're at an all-time high, right? And this is something that I've really been focused on now for months and months and months, calling out how we had this kind of rounding out behavior last year and making higher highs as we continue to kind of progress through this range. And I think, when we look at this initial spike here from the COVID period, that was a very unique time, right? So I think we can kind of blur that out. We've essentially been making new highs for the past, for a very long time, right? But the thing that I want to focus on specifically here, and this is actually for average data, which is fine. We should actually take a quick look at this. What I want to do though is change this y-axis. Instead of measuring this in billions of dollars, what we could do is we can measure this on a year-over-year rate of change basis. And what we could see is that the year-over-year rate of change, as for the month of August, was just above 11% year-over-year. And we could see this massive kind of V-shaped recovery in the rate of change in loans and leases. Again, at the onset of COVID, we had a massive increase, and then that number really kind of leveled off. And we actually had a negative rate of change in terms of credit issuance, right, and credit creation. But since May of 2021, when we bottomed, we've just been on this massive V-shaped recovery. As of the month of October 2021, we started to get a positive reading in the year-over-year rate of change. And this is, in my opinion, something that's really fueled inflationary dynamics. Because again, especially as we think about GDP as a measure of economic activity stagnating for 2 consecutive quarters, and not only stagnating, but going negative, but we still have incomes on the rise. What this helps to show is that more money, like I said, is leaving the financial system and entering the real economy. And when we have an economy that's not increasing its productivity or its output, what we actually literally have here is more money chasing fewer goods. And when we think about the classic definition of inflation and how inflation can be created, what we see here is a clear correlation between credit creation on a year-over-year basis and the rate of change in inflation. So again, with more money entering the real economy and leaving the financial system, we're literally having more money chasing fewer goods. And when that happens, the only consequence of that really is that the price of those goods must rise because they're being denominated by something that's more abundant, which is dollars in the system. So this is definitely something to continue to watch. Again, we're right at that 11.1% on a year-over-year basis, whereas for the month of July, we were at 10.5, the month before that, 9.6, month before that, 7.9, month before that, 7%. So this has been a massive and continuous rate of change in credit creation. Now, why is this happening? This is something that I've talked about a couple of times now, but I think it's worth reiterating. The Fed has been able to essentially steer market expectations through forward guidance. So all throughout 2021, they were kind of talking like, we're not even talking about raising rates, which eventually turned into we're starting to talk about raising rates. And then all of a sudden in November, they didn't mention that they're raising rates, but they did say we're going to start tapering and reducing the rate of our asset purchases. So basically since November of 2021, market participants, thinking about businesses specifically, have known that the Federal Reserve is withdrawing stimulus and going to be shifting towards an outright monetary tightening stance by raising interest rates. And so businesses recognize, hey, I better lock in new debt, new capital at these lower interest rates, because 6 months from now, 1 year from now, the cost of that debt is going to be much higher because the Fed is going to be raising interest rates. So market participants, and again, I'm specifically thinking about businesses here and even consumers, recognize, hey, now is the time to be borrowing because rates are going to continue to go up. And so whether we think about where we were 3 months ago, where we were 6 months ago, or where we were 9 months ago, that market dynamic has continued to persist. No one's talking about the Fed cutting rates. The only expectation is that rates are likely going to continue to rise from here. And so that dynamic is still very much in place. There's kind of a fire under the ass of businesses and consumers to go out and borrow today because the cost of that debt is going to be higher in the future, and you better lock in the relatively lower debt servicing costs today. The second reason why this is happening is because banks like higher interest rates environments because they're able to generate more revenue per dollar of loan that is issued into the system. In a higher interest rate environment, or let's think about it like this: if I'm lending $100 million at a 2% interest rate, I'm only generating 2% in interest income. Whereas if the interest rate environment goes up to 4%, now I'm able to double the amount of revenue that I'm able to generate via interest income, which has now gone to $4 million in interest income on the same $100 million loan. So banks have a natural incentive to issue more loans in a higher interest rate environment because they're able to generate more revenue per dollar that they extend their own balance sheet. So this is why we're seeing a massive increase here in terms of credit creation, and I still think this is arguably one of the most underrated aspects of what's driving inflation. People still don't seem to be talking about this. The final thing that I want to go over that I did review in that post on Twitter was the wage price spiral. And specifically, what we can look at is the drastic increase here in the 3-month moving average. I think this is this an annualized? I'm not quite sure. Either way, what we're looking at is the 3-month moving average of median wage growth in terms of hourly data. And so what we could see here is, per the most recent reading in August, we basically stagnated from 6.7% in July, again 6.7% this month. But still, what we're seeing is that from a historic perspective, wage growth is rising at a very elevated pace and has been for quite some time. If we go back all the way to the 2000s, is when we peaked above 5.4%. We've been above 5.4% since basically the entirety of this year, since February of 2022. The one thing that I really like to highlight when I talk about the wage price spiral is specific to this cohort right here, which are job switchers. And if we look at job switchers, we could see they're increasing their median wage growth at a much faster pace than the aggregate market, if you will. So even, we had a slight decrease from 8.5% to 8.4% on a month-over-month basis, but even still, this is drastically elevated from a historic perspective. And this was actually something that I reviewed in my latest newsletter this weekend on Cubic Analytics. But if we look at the growing divergence here between job switchers and job stayers, this is really, really strange, because I think we would always expect to see a divergence, and that job switchers would be generating higher income or faster wage growth than job stayers. But this divergence right here is historically high. We've never seen the spread be this significant. And so when we think about the quits rate basically being at 3%, then dropping to 2.8%, and now 2.7%, the quits rate is historically elevated because the labor market, people who are in the labor market, are able to go out and find an abundant amount of opportunities in the market, and they're able to command a higher wage because those jobs are so desperately needing to be filled, right? We have over 11 million job openings. I think the most recent data was something like 11.3 million. But we have a quits rate of 2.7%. And so when there are all these opportunities and employees are fighting to keep up with the rate of inflation, they need to go out into the market and switch jobs, because that's where they're basically able to generate outsized wage growth. If you're staying at your company, you're not keeping up with inflation. But if you're leaving your company, you are keeping up with inflation, right? That job switcher wage growth is 8.4%. On a year-over-year basis, the CPI is 8.5. But job stayers are only generating 5.6. So there's a clear gap there. And there's a clear reason why people are leaving their jobs in order to hunt for higher wages. So this is very important to watch. But again, I really view the dynamics that we're seeing in the labor market as setting a floor beneath what we're seeing in terms of inflation as measured by the CPI. So when we basically have nominal wage growth of I think it's 5.2 or 5.1% off the top of my head, when we have nominal wage growth growing at that pace and so consistently for so long, I know the number has dipped down now slightly, but still, I view that as a floor under inflation because I know that the real wage growth is negative. But if the nominal wage growth, that's basically showing us what personal disposable income growth is. And at a 5% growth rate on a year-over-year basis, that essentially means that consumers are essentially able to absorb 5% higher prices. All else being equal, right? I'm aware of that. But even still, again, it basically sets a floor for inflation dynamics. So we've reviewed 4 key components here, basically looking at how that might impact the August CPI data. And I know I sprinkled it in there in the middle, but I do expect the August CPI data to come in lower than what we saw in July, which was 8.5% on a year-over-year basis. And I think if I remember correct, the month-over-month rate of change was literally 0. It was plus or minus 0. I don't know where the month-over-month is going to shake out. Again, if we look at the aggregate commodity indexes, what we're seeing is a very stable rate of change on a month-over-month basis. So I think it's possible we might shake out right around that 0% range. I wouldn't expect a very sizable difference in the month-over-month rate of change, and I also don't expect a sizable difference in terms of the year-over-year rate of change. If I could basically apply a 95% confidence interval for what my expectations are for tomorrow, I expect to see between 8.3% and 8.6% on a year-over-year basis. Anything above and below that, I'll be very surprised. And so I think generally speaking, market expectations are for inflation to come in lower. So if we just look at the economic calendar for the week and we look at CPI, this is actually quite interesting, right? So the median forecast is 8% and doesn't show us the month over month. That's okay. Still though, we're going to it. The market expects an 8% in terms of the median forecast. So anything above that, I actually expect to see the market sell off quite a bit. Not substantially, but I would definitely expect to see asset prices come a little bit lower if we get something above 8.2 or 8.3%. The market is not going to be happy by a slightly lower CPI print. We need to see a sizable decline here, which again is why the median forecast is calling for an 8% year-over-year rate of change. I'm actually surprised to see it's that low. I would have expected to see about 8.2. But again, I'm still gonna, and look, I wasn't aware of this. I'm still going to stand by my 8.3 to 8.6% range. Because again, I don't think we've seen, let me say it this way, and I highlighted this back in June, right? Is that we have these 2 different dynamics, and then I even highlighted this in July or early August when talking about the July data, is that we're having a tug of war between these 2 dynamics. Again, commodity prices have come down, supply chain bottlenecks have drastically improved. However, the wage price spiral is still an ongoing issue. It doesn't really seem to have come down to any considerable degree or margin, and credit creation continues to accelerate higher. So on the aggregate, we have these 2 counteracting dynamics is essentially how I see it. However, I do expect the commodity factor to move inflation more than anything else. So this video went a little bit longer than I was expecting. I was hoping to do 20 minutes, so I'm going to cut it off here. I hope everyone has a great rest of the week, and I am very hopeful that inflation comes in lower. And I think everyone is very preoccupied about what inflation means for their portfolios, but kind of throughout this whole inflationary regime that we've been in, it's been very disappointing and sad to think about kind of the humanitarian impact behind the whole inflation story, right? And so as we know, inflation hurts the lowest income brackets more than anything else. And so when we're in a already somewhat difficult time from an economic perspective, we're seeing negative GDP growth. The closer and closer we get towards a stagflationary dynamic it's actually quite sad. So I think everyone's hoping to see these inflation pressures abate. With that said, be sure to follow me on Twitter at Caleb Franzen. And if you haven't already signed up for my newsletter, Cubic Analytics on Substack, I'd highly recommend it. Obviously, I'm a little bit biased, but we're growing like crazy. We have over 1,900 total subscribers on there, receiving our free weekly emails, weekly reports. And in each of those reports, I'm going to be covering the key developments that I'm seeing across the board in terms of the macroeconomic picture, the stock market, and Bitcoin. So if you're interested in seeing how all three of these kind of core pillars are interacting with each other and how data is feeding across each of these three dynamics, be sure to subscribe to that and receive weekly emails from me, Caleb Franzen, and I'd love to have you there at Cubic Analytics. So with that said, everyone, we'll talk to you very soon. Goodbye.